In the last class, we were able to give an introduction to partnership by defining partnership and then stating the elements of partnership and also looking at partnership agreements in terms of formal and informal. We also looked at the contents of partnership deed and the definition of partnership deed. We're also able to look at what we are likely to apply where there's no agreement or where there's an absence of agreement among the partners, talking about the Partnership Act 1890. So we're also able to look at the contents of what should be applied, from profit and loss being shared equally, no interest on salaries, no interest on drawings, equal capital contributions and all that. So basically, when there's no agreement between partners and there's a conflict that cannot be resolved, we apply the provisions of the Partnership Act 1890. So we had already looked at this in the last class. We also looked at some terminologies, okay, from current account, fixed account, to share of profits, to drawings, to interest on drawings, a whole lot of terminologies, to guaranteed minimum share, premium, guaranteed minimum share, discounted, guaranteed minimum share at par. So these are all terminologies that we discussed in the previous class. We also looked at change of interest, basically just the same way we had it in joint venture. But basically, in this class, we'll be looking at accounting for partnership businesses. So basically, we can say the final accounts of partnership, or partnership final accounts, accounting for partnership business. We're looking at the type of accounts that we usually prepare in partnership. Now, in partnership, we prepare trading profit and loss account. Okay, and the trading profit and loss account is the same thing that we prepare for the sole proprietorship. So trading account has not changed. Profit and loss account has not changed. I already explained that the trading account is a function of your turnover and your cost of goods sold. So you have your turnover here, and then you have your cost of goods sold. The difference between your turnover and your cost of goods sold is your gross profit. Okay, so the note here explains the items that form the turnover. I already explained that in our previous class on trading profit and loss account. Your turnover can be a function of your sales and your returns inwards. And then we have cost of goods sold. So it can be a function of your opening stock, your purchases, your carriage inward, your returns outward, and your closing stock. So we have that as a note explaining how it's been manipulated. Like, have opening stock, you add purchases, add carriage inwards, less return outwards. That gives you your cost of goods available for sale, and then you now less your closing stock. That gives you your cost of goods sold. Easy to the note 2 will give you how you broke those items down to get the cost of goods sold. So when you take out your cost of goods sold from your turnover, you have your gross profit, and then you have your other income income aside from the ordinary cost of business. For instance, you can have commissions received, you can have discount received, you can have rental incomes. Those are added to your gross profit. That's note 3 here, can have a detailed breakdown of those items that make up your other income. When you add it to your gross profit, you have your gross income here. And then the next is to less your total expense. So your total expense can be from your salaries to your rent to transportation, advertising, insurance, warehousing, depending on the type of expense. When you add them together, you have your total expense. So your note 4 will give you a breakdown of how you've added them together. So when you take that out of your gross income, you have your net profit or your net loss. Your net profit is where your gross income is higher than your total expense. You have net profit. But where your total expense is higher than your gross income, you have net loss. So basically, the trading account is prepared to derive the gross profit or loss, and then profit and loss account is prepared to derive the net profit or loss of the partnership. Now, the next account is the profit and loss appropriation account. To appropriate here means to share, to divide, to apportion. So usually after preparing the trading profit and loss account, you derive your net profit. So the net profit is divisible, okay, among the partners. So the accounts in which we show how the net profit is what apportioned among the partners is the profit and loss appropriation account. So in the profit and loss appropriation account, the profit divisible among the partners is stated or showed there. Then it is also possible that the partners make some additional income from themselves. What I'm trying to say is that because of the fact that partners could have withdrawn cash or withdrawn goods from the business for their personal use. Okay, usually in partnership, when partners take out goods or take out cash for their personal use, it is usually agreed that the partners pay back with some interest. So it means that if you withdraw goods worth 1 million for your personal use, it is expected that if you had not withdrawn, if this product were sold, there would have been a profit on the product. So basically, when partners withdraw goods from the business for their personal use or withdraw cash for their personal use, they pay back with interest. So the interest on the drawings is an income to them. So we show that in the appropriation account. So we now also show how the profit is now shared among the partners. Some partners are paid salaries, some partners are paid allowances. Okay, so and then the capital that the partners have contributed to the partnership business usually attract interest. So we pay them the interest in the appropriation account. So after paying them their interest, paying them their salaries, the remaining profit becomes what they call share of profit, and then we share it among the partners in the agreed ratio. It can be equally, it can be in the ratio of capital contributed, or whatever ratio that the partners agree. So if you look at this appropriation account, so we can see X and Y. These are the two partners involved. So we say profit and loss appropriation account. Okay. Now we have net profit brought forward. This is the profit that the partners have as income. So this is the profit from where the trading profit and loss account. You bring it down or bring it forward. So now it is possible that the partners had drawings, and the drawings, there's interest on the drawings. So the interest charged on the drawings is an income to the partners. So you have interest on drawings. So X is paying an amount, Y is also paying an amount. So this 2 added to this is what we have here. So this is the actual total income to the partners that partners need to share. So out of this, it is possible to have salaries paid to some partners. So if you pay salary to Y, for instance, so that will be paid out of the profit. And then the interest on the capital contributed by the partners. So we have X, we have Y. So this is X, this is Y. So when you take out these 3 from the total income here, then you have the share of profit as a profit that is supposed to be shared among the partners. So you share it between X and Y. So when you share the balance between X and Y, so X takes its own, Y takes its own. When you add up, it is equal. So basically, what you're doing is get the income that the partners have to be shared, add any other income that the partners have made among themselves, and then take out whatever expense they have agreed to pay to each partner. So whatever is remaining, you share it among the partners on or based on the ratio that has been agreed. Now, the partners' capital account. So this is the account where we show the balances of the partner's capital from time to time. So if you have like 2 partners or 3 partners, and each partner has contributed 2 million naira, so we have to show an account that shows the balance of the capital from time to time. Okay, so I told you we have 2 types of accounts: fixed capital account and fluctuating or floating capital account. When you say fixed capital account, it means that the balance in the account does not change. So if you have contributed 2 million naira from inception, the balance in the capital account remains 2 million naira all through the partnership duration, partnership period. So whatever excess you have is taken to the partner's current account. So that is when you're operating fixed capital account. So when you have a fixed capital account, you do not change the balance. So if there is a profit or there is an interest that the partner has earned that needs to increase the partner's capital, it does not go to the partner's capital account. We take it to the partner's current account. So the idea is whenever there is a fixed capital account in the partnership, any excess or decrease is transferred to the partner's current account. But if you're operating a fluctuating or floating capital account, whatever excess you have still goes to the capital account. But in this case, we are operating the fixed capital account. That means the balance in the capital account of the partners do not change. So we have A and B. So we have partners fixed capital account. You can see debit here for A, B, credit here for A and B. Capital is more like a liability to the business, okay? Because I told you, I said capital is the commitment of the owners to the business. So the business is owing them. And besides, if you remember your trial balance, capitals have credit balances. So balance brought forward there is in the credit side, A, B. If you have issues with understanding balances of items in terms of asset, liability, expense, income, I already explained that in our trial balance class. So you can go back to our trial balance class on our YouTube channel to understand how items are treated in the trial balance, okay? So you'll be able to know how assets are treated, like assets are debited, expenses are debited, incomes are credited, liabilities are credited, provision for asset items, okay? I already explained that, how they are treated in the trial balance. So you can go to that trial balance class to understand that. So basically, this is the partner's fixed capital account. It does not change. Any excess goes to the partner's current account. Now, this is the partner's current account. I already explained that when you have partner's fixed account, then you must operate a partner's current account. When you operate a partner's fluctuating capital account, then there's no need for partner's current account. So basically, whenever you're operating fixed account, you must operate a current account. Okay, so the current account takes the excesses that cannot be taken to the partner's fixed account, that's capital account. So fixed capital account does not change. If you have an excess like share of profit, like interest, okay, you take it to a partner's current account. So this is operated concurrently with the partner's fixed account. The partner's current account is the account that records the excesses that cannot be recorded in the partner's capital account from time to time. So this is what you see here. You can see X and Y, they are in the partnership. This is the partner's current account. The same way you have debit for X and Y, you have credit for X and Y. Okay, so current account basically is more like an income item to the business, or a liability item to, income item to the partners, but a liability item to the business, because the business is owing the partner, so they have credit balances. Okay, so we have partner's current account, balance brought forward. So partner X, partner Y. That's the balance brought forward. So we have drawings. That's the personal goods or cash taken by the partners from the business. So we take it out of Out of their individual account. You debit them with it. So the interest they are paying on the drawings, you debit them with it in the current account. So interest on capital. Remember, the partnership is paying the partners, interest for the capital that they contributed to the business. So to the partners is an income. Okay, so you credit it to the account. And then we have salaries paid to the partner. So in this case, it was paid to Y. And then the share of profit from the appropriation account as well. We bring it straight down here, X and Y. So at the end, you compare the total in X credit side with the total in X debit side. So if you add 1, 2, 3, you take out 1, 2, you have the balance carried down. So if you add 1, 2, 3, 4, you take out 1, 2, you have the balance carried. So basically, you compare Y total credit with Y total debit, and compare Y total X total credit with X total The difference is your balance carried down. So if your X credit is higher than your X debit, balance carried down is in the debit side here. If your Y credit is higher than your Y debit, balance carried down is in the debit side. So the balance carried down becomes the balance brought down here. So it depends. So if your debit side and your credit, then balance carried down goes in credit. So you have to know which is higher. Okay, the balance carried down stays in the lower or the lesser part of the columns. So the balance sheet, I already explained what the balance sheet is. It is a statement that shows the financial position of the business, okay? Stating the assets and what liabilities as at the particular period of time. So usually it's the same. We already explained what the balance sheet is. So you have statement of financial positions at 31st March 2018. So we have assets. Your asset can be your what non-current asset or what they call fixed asset, okay? So the note 5 we detail it. So there you can have what are the fixed asset items or non-current asset items, your land, building, furniture, equipment. Add them together in that note. Total, you bring it here. Other assets, so any other asset aside from fixed assets. Maybe you have goodwill, patent right, copyright, some fictitious asset that has to be recognized. Excuse me. So the total there is what we call other assets here. So the note will show the breakdown of the value. So when you add this to this, you have this. Current assets, your cash, your debtors, stocks, prepaid rents or prepaid expenses, okay? Accrued incomes, all right? So any of such items form current assets. So the note will tell you the breakdown. When you add up, you have this. So this is this. So I already explained preparation of trading, profit and loss account and balance sheet in a class. So you can go to my YouTube channel, Jado's Consulting, okay, and then check out trading, profit and loss account and balance sheet there on our YouTube channel. Okay, so it's the same thing basically. So we have liabilities, long-term liabilities that span over a period of time. Okay, so what do you have? Note 8 will give you the detail, the breakdown. So you have it here. Okay, what are long-term liabilities? Bank loan, okay, and any other long-term obligations that the business had gone into. So we have it here. Short-term liabilities, periods, the short-term obligations, that is liabilities that should be settled within an accounting year. So we have it here. The note 9 means the breakdown. For instance, we have bank overdraft, you have accrued expenses, okay, or maybe prepaid incomes. When you detail them like that in a note, the total is what you're bringing here. So this is the note that shows the detail. And then we have partners current account, okay. So this is just the different. This is what differentiates between a partnership balance sheet and a balance sheet for sole trading. Here you have to show the partners balance. So the current account here is the partners balance. Okay, the excesses that we could not take to the capital account. Okay, so this is the balance. If it's a credit balance, then it is positive. If it is a negative, if it is a debit balance, then it is what? Negative. Here is the credit balance, so put it there for X, put it there for Y. So when you add this to this, you have this partners equity, that's the partners capital account, okay, for X and then for Y. So when you add this to this, you have this. When you add this, and this, okay, you have your total what? Liabilities, which is this. So at the end of the day, your total liability must be equal to your total asset. That is the essence of the word balance sheet, showing the assets and liabilities of the word partnership. So here is a question, okay, that will help us prepare partners accounts or partnership accounts, okay, for a going concern business basically. So here we have the following, okay, we are extracted from the books of A and B in what? A partnership. So we have net profit for the year. So basically in this question, they've already prepared the trading profit and loss account. So we don't have to prepare that. But even if you have a question that wants to prepare trading profit and loss account, remember the essence of your trading profit and loss account is you want to derive your net profit or your net loss. So it's the same way of preparing it. So instead of preparing that, they just gave us the net profit for the year. So that means the trading profit and loss account has been prepared. Because the essence of the trading profit and loss account is to what? Derive the net profit of the business. Okay? So basically, you have net profit for the year, 32,000, land, 240,000, partners drawings, A, 30,000, partners drawings, B, 25,000. We have motor vehicle for the business, 270,000, equipment, 250,000, bank loan, 450,000, overdraft, 120,000, capital for A is what? 100,000, capital for B 80,000. Current account for A, 90,000. Current account for B, 60,000. Debtors, 72,000. Cash, 45,000. Goodwill here is dash, nothing. Okay, so they now said partners agreed as follows: profit or loss to be shared in the ratio of what? Capital. They now said interest on drawings to be 10% per annum. Interest on capital to be 10% per annum. Partner A to be paid 2,000 naira as allowance for being active. Okay, goodwill to remain in the books, but there's no goodwill. Goodwill is 0, so let's assume there's no value for goodwill. So you are required to prepare profit and loss appropriation account, partners current account, partners capital account, balance sheet as at that date. So what's the first one there? Profit and loss appropriation account. Okay, I already explained that the profit and loss appropriation account is the account that details how the profit generated by the partnership is what? Divided or apportioned among the what? Partners. So we have net profit here. That's the net profit from where? The trading profit and loss account. But in this question, they already gave it to us, so there's no need for us to prepare trading profit and loss account. But where the question says prepare trading profit and loss account, go ahead and prepare. So whatever profit you derive, okay, is what you bring toward the appropriation account here. But in this case, the profit is already in the question. So we pick it. You can see net profit for the year, 32,000. That's what you have here, 32,000. Now, the question said the partners agreed that there should be what? Interest on drawings to be what? 10% per annum. So what is the drawings of each partner? So you have partners drawings. A is 30,000. Okay, B is what? 25,000. So, the interest on the drawings is an income to the business. That's why it is added to what? The net profit. So, interest on drawings. A is 0.1 times 30,000, which is 3,000. B is 0.1 times 25,000, which is 2,500. Let me show you. The drawings for A is 30,000. Agreement says interest on drawings to be 10% per annum. So 10% on 30,000 is 3,000. Drawings for B is 25,000. Agreement said interest on drawings to be 10% per annum. So 0.1 times 25,000, which is 10% of 25,000 is what? 2,005. So that is the income to the partnership. So what are the expenses to the partners? Remember, they said what? Partner A to be what? Paid 2,000 naira as allowance for being active. So we have allowance to A, 2,000. Okay. Okay, so the allowance to A is what? 2,000. Now we have interest on capital. The partners brought in an amount of capital that needs to attract interest, for putting it in the business. Okay, so now what is the capital? So we have partners capital. A here is 100,000. Then they said the agreement is what? Interest on capital to be 10% per annum. So A here will be 10 over 100 times 100,000, which is what? 10,000. B's capital is what? 80,000. So we have interest to be 10 over 100 times 80,000, which is what? 8,000. So basically, if you add this 2,000 to 10,000 to 8,000, you have 20,000. So if you have 32 plus 3,000 plus 2,500, you have 37,500. So 37,500 minus 2,000 minus 10,000 minus 8,000 gives you what? 17,500. So that is the profit that will be divisible or shared, okay, among the partners. So we have share of profit. A, remember, it was said that profit or losses to be shared in the ratio of capital. Okay, so basically, what is the capital of what? The capital of, where is the capital? Capital of A here is 100,000. Capital of B here is what? 80,000. So 100,000 plus 80,000 is 180,000. So basically, you can, adjust for it to the nearest to what significant number here. So we can just say 10 and then 8, because here we can take out the 4 zeros here. 1, 2, 3, 4. 1, 2, 3, 4. Okay. So here we have 100,000, we have 80,000. So we can just take 10, take 8, since we have 4 common zeros in both. So we can say 10, 8. Okay, so 10 plus 8 is 18. All right, so if you can have to say 100,000 divided by 180,000, but that might take your time. So let's just say 10 and 8. So we have 10 plus 8, which is 18. So for A to be 10 divided by what? 18. So which is as 100,000 divided by 180,000 times 17,500. That gives us 9,722. B will be 8 divided by 18 times 17,500. You can actually say 80,000 divided by 180,000 times 17,500. That gives us 7,778. So when you add all together, okay, it agrees. So it means that the profit remaining has been shared among the what? Partners. So the next one says partners' current accounts. So let's go. This is the partners' current what? Accounts. Okay. So we have balance brought forward. Are you there? So what is the current account balance in the question? So we have current account for A, 90,000. Current account for B, 60,000. So that's what you have here. Balance brought forward. A, 90,000. B, 60,000. Now, A made a drawings of 30,000. Look at it here. Partners drawings. A, 30,000. B made a drawings of what? 25,000. So you take it out by debiting them. Drawings 30,000. Okay, for A, 25,000 for B. Now, their drawings attracted an interest that they paid based on the agreement. Okay, remember, they said the interest is what? 10%. Look at what we have here. 10% of what? 30,000. Okay, they paid it to the business, so that is going to be a loss to them. That's why we're debiting them in their what? Current account. So interest on drawings here, 3,000 for A, 2,500 for B, 10% on the drawings. Okay, so 10% on 30,000 is 3,000, 10% on 25,000 is what? 2,500. So then they also had their own incomes. So allowances. Okay, A got an allowance of 2,000. Remember, it's in the question. You can check out the question here. Partner A to be paid 2,000 as allowance for being active. So if you look at your appropriation account, it was an expense to the what? To the business, but it's going to be an income to the partner. So allowance to A, 2,000. Interest on capital, remember, 10% on capital. So A's capital is 100,000. So 10% of 10,000 is what? 10% of 100,000 is what? 10,000. Remember, it was an expense to the what? Business, because the business paid the partners. Let's check out our appropriation account. Remember, look at it. This is our appropriation account. It was paid to the partner here as an expense. So to the business is an expense, to the partners is an income. So we have interest on capital here. A, 10,000. B, 8,000. Then the profit that was shared among them. Remember, the business will have to share the profit that is remaining, which was 17,500. So we shared it in the ratio of capital contributed. Recall, look at it here, share of profit. A, 100,000 over 180,000 times 17,500, 9,772. B, 80,000 over 180,000 times 7,500, that's 7,778. Okay, so it's an expense to the business, it's an income to the partners. So we have share of profit here, 9,722, and then we have 778. A is 9,722, B is 778. So at the end of the day, you compare the credit side of A with the debit side of A. So if you add 92,000, 10,000, 9,722, you have 111,722. Take out what? 30,000 and 3,000, you have 78,722. That's the balance on A's account. So if you look at B, 60,080, 778, you have 75,778. Take out 25,000 and 2005, you have 48,278. That's the balance on B's account. So that is what turns to balance brought down here. 78722 48722. So that's the partner's current account. Next one says partner's capital account. Remember, if you're operating a partner's current account, it means that you have fixed account for the partner. It doesn't change. So we have partner fixed account here. A, B for debit, A, B for credit. So balance brought forward is 100,000, 80,000. Like I said, because it's a fixed account, it does not change. Okay? Any excess goes to the current account, which we have already done. So that's it, 100,000. Okay? 80,000 for B. The next one says balance sheet as at that date. So this is our balance sheet. Remember, our balance sheet states what? Your assets and your liabilities. So basically, current asset 5. So you have here the land, building, motor vehicle, office equipment, 240, 270, 250, 760. We have 760 here. Other assets, there's no other asset. Current assets, you can see what are the current assets. Cash at hand, 45,000, debtors, 72,000. Then the question, look at it here. We have cash, we have debtors, okay? So when you add all this together, you have 877,000. So your long-term liabilities note 8. Look at it, bank loan, 450,000 is in the question, okay? So we have 450,000. Short-term liabilities, bank overdrafts. Where's the notes? 120,000, okay? So we add together, you have 570,000. So partner's current account, we already prepared the current account, so go and pick the balances. Where's the balance for what? A and B here. So A is 78,722, B is what? 48,278. Look at it here. A 78,722, B 48,278. When you add, you have 127,000. Partner's capital account, we already have it in the fixed capital account there. A is 100,000, B is 80,000. When you add together, you have 180,000. So when you add this, you have 877,000. So that's total liabilities equal to your what? Total assets. So that is your balance sheet showing your assets and what? And liabilities. Okay, this is the class for the partnership trading profit and loss account, appropriation account, current account, capital account, and the balance sheet. If you have questions, you can reach me on 08136506 or send me an email, jeremiah.dus